Hi, I'm Fook with Alpha B Group, and today we're going to talk about the difference between an NSO and an ISO. So if you work at a startup, you should watch this video. Also, I'm going to assume you already know all the terminology behind stock options, such as grant date, vest date, strike price. And with this video, I'm going to show a comparison between the two ISOs and NSOs side by side. It's going to be a really quick video explaining the difference. So moving on. Let me move my face, make this smaller. And, oh, I can't even move it there. Okay, can we move here? Oh, there we go. That's better. Okay, so the difference between NSOs and ISOs. When it comes to the grant itself, the terminology are the same. They all have vest date. They all have number of shares that are granted to you. They all have strike price. For vesting, when it comes to vesting, there is no income tax when the stocks are vesting, or for NSOs and ISOs. There are no taxes when it comes to vesting. The taxes will come in when you exercise the shares. And there are two things you could do after you exercise. You could exercise and sell, which is normally same day sale, and you can exercise and hold. When you exercise and sell same day, there are no differences in taxes between the two. Actually, the only difference is how taxes are withheld. So let's just say with your NSOs here, if you exercise and sell same day, they're going to write you out a check, but they're going to also withhold taxes from that check. So you get a lesser amount. Now be careful, because the taxes withheld is probably not going to be enough to cover your actual tax bracket. So for example, they might hold 22% for federal, but you actually might be in a 33% bracket. So there could be that shortage. So make sure that you understand that you still might have to pay extra taxes to cover that difference. Now for ISOs over here, when you exercise and sell same day, they're going to write you out a check, but they're not going to withhold any taxes. So you're not going to see any tax withheld. So you're responsible for making a tax payment yourself. So you have to do this by making a prepayment or an estimated tax payment. I have a video that talks more about prepayment estimated tax penalties. If you want to watch that, it's probably going to be up here somewhere. The next thing I want to talk about is exercise and holding. Now, this is where it gets super complicated between the two. This is where the vast differences between NSOs and ISOs lay. Is if you decide to exercise and hold, and you're going to try to go for long-term capital gains. So for exercise and holding on NSOs, the delta between the strike price and the fair market value price at time of exercising is going to be ordinary income, meaning that this is going to show as income on your W-2 and you have to pay taxes on it. And this sucks because you haven't even received any cash for it because you haven't sold it, and you still have to pay taxes on it. So because of this, if there's a large delta between your strike price and your fair market value price, you have to report that as income, unfortunately. Now, the other thing that sucks is that because you have to pay taxes on it, the company most likely will ask you to write out a check to cover the basic taxes on it. Just be prepared for that. You're going to pay long-term capital gains on the delta between the fair market value at time of exercising to whatever you sell it at. Now, I know this is complicated. I do have another video coming out for NSO specifically that will show you a chart and graph that explains it in more detail. I know I'm going really quickly over this, but hopefully watch that other video if this relates to you. Now for ISOs, this is going to be complicated, super complicated, because now we're dealing with alternative minimum tax. So the way it works is that when you exercise and you hold, the delta between the strike price and the fair market value price at time of exercising is not income tax like how NSOs are, but instead we have to calculate that delta as AMT tax calculation. So we have to run a separate calculation to see if you owe AMT taxes on it. So it's still possible that you could exercise and hold and not be affected by AMT if you haven't reached that threshold, because the only time you pay AMT is once you go over a certain range, then you start paying AMT. So in general, what we try to do is have clients exercise enough before hitting AMT, because once you hit the AMT range, it's really hard to get out of it. Also, when you exercise and hold for ISOs, there are going to be no taxes withheld. So if you do hit the range where you start paying AMT because you exercise so much that you're going to owe taxes for the AMT, but the company won't withhold anything for you. So you're going to be responsible for prepaying and paying estimated taxes on that section where you pay the AMT tax. Now, the good thing about the ISOs is that long-term capital gains will be from your strike price to whatever you sell at. And we just have to make adjustments for AMT later on when you sell. So again, I want to have another video just separate for ISOs that explains the details of that. And the last part between the two with ISOs and NSOs, you have to front up the money. If you're going to do exercise and holding, you have to front up the money to buy the shares from the company. So if the shares are 2 cents each, you can just buy a bunch of them without any problem, and you just front up the money to buy it. However, if your strike price for the shares are $10 each and you want to buy 1,000 shares or something, just know that you have to front up that money to buy the shares. So the risk when it comes to NSOs and ISOs is, one, for NSOs is that you have to front up the money to buy the shares, but also if there's a big delta, like you exercise way later on, and there's a big delta between the strike price and the fair market value price, then you're going to have to pay taxes on that. So that's another risk that you're putting up front. For ISOs, really, unless you stay underneath that threshold where you don't pay AMT, then the only thing that you are risking is the money you have to front up to buy the shares. But if you do end up going into the AMT range and have to pay AMT tax because of it, so you're going to risk the money that you've had to buy the shares with, and also that AMT tax that you have to front up when you file your taxes next year as well. So that's just a quick rundown of NSOs and ISOs. Hopefully that made sense. If there are any questions, you can write in the comments below. I would appreciate it if you click the like button that lets me know I'm doing a good job. Also, if you have colleagues that might benefit from this information, you should share it with them. Other than that, I'm off to my next video. Wait. I forgot to also say that for NSOs, ISOs, anything with stock options, highly recommended to do a tax planning session to make sure where you stand tax-wise in case you do want to exercise, or if you already did exercise, you want to know where you stand just to be more prepared for taxes when it comes to paying it. So definitely do a tax planning session. It's really important because all my clients that don't do a tax planning session and then they exercise all these ISOs or NSOs, they get a big tax surprise that they weren't ready for, and I have to be the one that breaks the bad news to them, and I don't want to be that person to do that. So make sure you plan a tax planning session because it's really important.